just focus on what's happening in commodity markets. Manisha is here with what is top of mind. Gold certainly is not top of mind. Gold prices actually from the recent highs are down about 5% or so. The other one I think which Manisha will talk about is oil. Big drop big drop, Manisha.
Well, the wrong guess really, yes, but crude oil prices did see a decline of 2% on Wednesday. But one thing that also has seen a very sharp decline coming in, Prashant, has been the copper prices. Fell 5% on Wednesday, saw some more decline in the markets yesterday. The US fell 5%, while the LME copper prices declined by 3% on Wednesday. It has been a very sharp decline that we have seen come in for copper, and I'll shortly come to the fundamentals as well. But traders have been unwinding arbitrage positions across US, LME and Shanghai. Those are the three important major trading markets and the global markets there. And we have seen premiums and discount work there. So we've seen a huge unwinding. And the unwinding has happened because China is headed into a long weekend. It's a 5-day holiday, Labor Day holiday in China. And that really has led to markets being shut there. And we have seen a lot of unwinding happen because of that there. Well, markets also are reacting to the weak US GDP data. The numbers clearly have surprised on the lower side there. And when you look at the China PMI number, that also came in at a 16-month lows. We've seen export orders at the lowest since 2022. So very weak economic numbers coming in from US and China has been yet another reason that you saw a sharp decline come in for copper prices. Well, US is reviewing potential tariffs on copper imports, and that has kept the copper prices on the higher side. But with the easing of tensions between US and China, that has led to some profit taking coming in, not just in gold and crude, but in copper as well because of that reason. The copper prices, though, could be looking at some support going forward because there are supply concerns in Peru. The two important mines, Antamina and La Bambas, are looking at unrest with the workers there, and that can be supportive. But most importantly, what the copper prices will react to going forward from here is really going to be the International Copper Study Group numbers that came in over the last day. Well, if you look at the markets, they are anticipating a surplus going forward. We did see a surplus in 2024-25, could be looking at almost a double of a surplus there, and above 200,000 tons of a surplus is anticipated for 2026 as well. Now, the ICG also is talking about the world mine production, and here as well, the numbers are quite on the stronger side. In the last few years, we've seen mine production increase by 2%, and while 2025 is anticipated at 2.3%, next year could be higher at 2.7%. So we're looking at higher mine production and higher inventories as well. So surplus is what the street is working with. The world smelting capacity also is expected to increase by 2.9% in 2025. And when you look at copper smelting, it is about Asian markets here. Whether it's about China, India or Indonesia, this is where you will see higher smelting capacity coming from. Take a look at the demand numbers there as well. So while in 2024, we saw demand gain up by 2.8%, it is anticipated lower in this year because of tariff concerns and recession concerns as well, weak economic data as well. And when you look at the consumption, that is expected to go even lower, below 2% in the next year. And that is what really seems to be bothering the copper prices. So while we have seen all-time highs in US for copper in this year, whether those prices will come back yet again in this year, the street expects that not to happen. What is that in focus today is going to be the US non-farm payroll data. While the longer term for copper is still under pressure, the near-term cues clearly would come in from this data.
Absolutely. And that's later today around the time that US markets open up. Manisha, thank you very much for that. So that's commodities in focus. We take